Hey everybody, it's Scott Zano from the Scott Zano Realty Group at Keller Williams Luxury Real Estate, coming back at you one more time. So lately, over the last year or two, I keep hearing the same terminology, 1031 tax exchange, 1031 tax exchange. So I've done a few of them in the past years, but I never really understood exactly how they work and why people do a tax 1031 exchange and what the benefits are. So today we're going to talk about 1031 deferred tax exchange, why people do them, the benefits that might help you, and some of the rules and regulations that apply, because if you don't do it right, it'll get kicked and you will not be able to get your tax deferred, and then you have to pay capital gains on it, which is the whole reason why people do 1031 tax exchange. So I'm going to go over what is a 1031 tax exchange, how it works, and I'll be reading a little bit here from my notes, but I felt that this was a very important topic to talk about today, because I hear and see more and more people doing 1031 tax exchange. If you're in the real estate market, you're going to play the game. This is something that I think you'll find very interesting. So it's called a 1031 tax deferred exchange, sometimes referred to as the Starker exchange. So a 1031 tax exchange, you have to sell a like kind of a property of greater value. So if you buy something for 100,000, you have to do a tax exchange for something that's worth more than 100,000. Okay. When you do buy another property, the whole idea behind the tax exchange is you don't have to pay the capital gains on the difference. Okay. So a 1031 tax exchange allows you to buy a piece of property and allows buyers and sellers to invest in properties while deferring their payment on all or some of the incurred capital gains taxes at the time of the exchange. All right. So you're taking the profit that you buy, the property that you bought, and you're buying another property of higher value of like kind, right? And when you sell that property, let's say you pay $100,000 for it, and you sell it for 150, then there's $50,000 there at capital gains, right? So what the 1031 does is it allows you to defer that 50,000, and then you can apply that towards your next sale, and it defers it so you don't have to pay it. But there's all kinds of good stuff that happens with 1031 tax exchange. That's just one of them, deferring your taxes. All right. So how do you do a 1031 exchange? So the first thing is they recommend that you retain a qualified intermediary, which would be a professional real estate agent, or someone that you know that understands 1031s, or an attorney. All right. So that's the first thing, is finding someone who knows how to play by the rules. The next thing is identify a property, right? And the third thing is to purchase a replacement property. All right. Now, you only have 45 days to identify that property once you sell the property that you're selling. Okay. You can't stretch this out. It has to be identifying property within 45 days of when you sold your property. Okay. If not, then you're going to have to pay the capital gains on that property. There's what they call a 200% rule. And what it is it's like, let's say you had a piece of property for $1 million. You could identify up to 3 properties, not to exceed 200% of the relinquished value. An example would be, if you had $1 million property, you sold that you could identify properties not to exceed $2 million. All right, for the purchase property. You also have to close that property within 180 days from the sale of your existing property to complete the exchange. So you have 45 days to identify, and you have 180 days to close. If you do not do that, it's what they call a failed exchange, and you'll have to pay the capital gains tax. All right. The same individual that's selling has to be the same person buying. Okay, that's pretty self-explanatory. The same person that's selling the property for the next property has to go in that same name as the seller. So the seller has to be the same name as the buyer. All right. Once the 1031 tax exchange is complete, the seller does not have to pay the full amount of the capital gains that they would normally have under normal circumstances. So again, the 1031, it defers those gains to a later date. The property has to be at or above the replacement property relinquished value. So if you're selling a property for $500,000, the rules state that you have to buy a property that's higher value than the 500,000. There is a way that you can buy the same amount, and they call it a boot. And I'm not going to get into that right now, but just for today's video, if you're going to do a 1031 and you're selling a $500,000 property, try to identify 3 properties above 500,000 so you don't get caught in the this what they call the boot, which is fine, but it's just another term that they use. Let's see. So the property has to be at above the replacement property, the relinquished value. No taxes would be paid at all on that. You can do as many 1031s as you want. Okay, there's no limit. Here's kind of an interesting point that I wasn't aware of. If I did a 1031 tax exchange and I was to pass away, those capital gains get erased for me. And then the property goes to my heirs. And then there's a way that if the heirs was to sell the property at the higher value that it's worth at that point, then those capital gain taxes start from that point on, and it gets a little bit complicated. But there is a way that if I buy a piece of property, I don't have to pay the capital gains should I pass away. They would go to my heirs. So what kind of properties qualify? So second homes must be used for at least 6 months before they qualify for a 1031 tax exchange. A business or an investment property will qualify for 1031. A flip does not qualify for a 1031 tax exchange. The property must be a like-kind property, and this is where it gets a little bit of a gray area for some. A like-kind property, has to be a like-kind property. We're going to get into that, but you cannot exchange a domestic property for an international property. Okay, it has to be real property only. No personal property, no franchise licensees, no aircraft, no artwork, and no boats. Okay, so it has to be real estate, real property. Okay, an example of some tax exchange properties would be business, farmland, raw land, rentals, industrial, retail, and residential rental spaces. Okay, it's good stuff, right? There's a lot to know about 1031 exchange, and I'm covering about 90% of it here today on this video. I hope you guys all find it of some value and get something out of it and help you do a 1031 so that you can increase your real estate portfolio and wealth. So you can do a tax exchange in one state and do it in another state. That is allowed. You can buy one big property and do an exchange for maybe 3 smaller properties that add up to equivalent or greater value of that one property. What you cannot do is you cannot sell your residential home that has not been converted to a rental property for 1031. You cannot do a primary property for a business property. And you cannot do a flipped property. We talked about that. The benefits of doing a 1031 tax exchange is to help you grow your real estate portfolio and grow your wealth faster by deferring all these tax gains, right? So it defers your capital gains. That's why people do 1031s, so they don't have to pay the tax. We talked about the if the person that's doing the 1031 exchange, all their debt would get erased upon their death, and then it would go to the heirs. One of the cons about doing a 1031 tax exchange, if you're not lined up with the right people, is if you don't follow this program to a T, it might come back and bite you, and you'll end up paying the capital gains tax. So it's very important that you talk to someone like we talked about earlier, the intermediary, an attorney, or a professional real estate agent that understands 1031 tax exchange and how they work. So the biggest thing is you have to identify a like property within 45 days, close within 180 days, and then make sure that the property qualifies in all aspects of the 1031 exchange. You can talk to your attorney about that, and they can steer you on the right course on whether the property is going to qualify for the 1031 exchange. The last thing I'd want to see is you go out and do all this work and then the property not qualified. That's one of the biggest problems 1031 has, is people are not qualifying the right property. So 1031 exchange is an amazing article to work with and helping you build your real estate portfolio and your growth. And not only that, but it will help you defer your taxes, and you can just start at a smaller number. Let's say you bought something for 500,000 and you kept it, you deferred your taxes, you buy something for 700,000, then you sell that, makes the profit on that, defer those taxes. You can do it as many times as you want, as often as you want. And so that's why people do 1031 tax exchanges, so they don't have to pay the taxes and they can increase their portfolio and their real estate wealth. I hope this 1031 tax exchange deferred video has been a big help. If you have any questions, please give me a call back at 508-566-0051. Shoot me an email at sjzano@gmail.com. Thank you so much. Go out, buy a piece of property, hold it for a couple of years, do a 1031 tax exchange. You'll be glad you did. Bye-bye.